And good evening, everybody, and welcome to the Sunday Night Quantum Quick Start. It's your forward focus for the week here at QS2. And boy, I'll tell you what, we got a great topic tonight, an important one for all of us QS2 champions, and that's life insurance. And boy, the importance of what we play, the role we play in helping people all across the country in regards to life insurance. And you're going to hear some tips tonight that's really going to take your business to a whole new level. And to help us with that is our CEO of QS2. He joins us from California, Dan Ahmed. Dan, good evening.
Good evening, Jim. Good morning and evening to all those people out there. I'm still in Hawaii. It's still kind of early, I know, and hopefully we got Bill Begonia, his team on there. I just got back from Seattle. I was up there Friday, Saturday, and Sunday with the great Dan Kim's team up there with Betty and Jackie, just doing wonderful work, and back off the plane and right here to do the Quantum Quick Start. So we have some great training today. Today we're going to focus on some life insurance training. And first, of course, we'll go over the weekly schedule, and then we'll go over our life insurance training, which will include giving you an example of what traditional term would look like, return of premium term, IUL target funding, IUL preferred funding, premium distribution summary, and a death benefit summary. So I'll give you an explanation of those also. And we always want to make sure you understand that Quantum Quick Start is really meant on Sunday to start your day and your week on a Sunday. We don't want to wait until tomorrow, because we want to get a jump on the competition, and we thought it was very important to do some life insurance training today. It won't be on product, but it'll be on understanding how life insurance actually works. Give you a quick view of the weekly calendar success. We have today, Sunday, 7 p.m. West Coast time, 10 p.m. Pacific, East Coast time, we have our quick start. That's what we're doing right now. Monday through Friday, 7:30 a.m. Pacific time, 10:30 a.m. East Coast time, we have our Quantum Connection live, Monday through Friday. We have our leadership webinar hosted by Kelly Schnorrenberg, Mondays at 7 p.m. Pacific time, 10 p.m. East Coast time. We have our national BOPS, Tuesday and Thursday, 7 p.m. Pacific, 10 p.m. Eastern, and then Saturday morning, 8 a.m. Pacific, 11 a.m. Eastern. And we have our product trainings going on Wednesdays. That will be at 12 p.m. Pacific, 3 p.m. Eastern, and 7 p.m. Pacific, 10 p.m. Eastern. So a lot of information. A lot of times we'll have some extra training that we'll try to give you a heads up on, and we'll make sure everything is recorded and available to you in the back office. So what we're going to do, we're going to cover what I think is very important, and that is understanding how insurance, the different types of insurance that we sell, work. And some of you are going to be out there, you're going to sell term insurance, and you'll love selling term insurance. And some people, that's what's going to be required, whether it's their budget, whether that's what they want, whether that's just what fits their plan. A lot of people are excited about return of premium term. They love selling it. Well, we're going to go over how that works. Then we're going to look at the scenario of selling an index universal life plan with what's called target funding. And target funding typically is minimum funding. Target funding is typically what you get paid commissions on. Then I'm going to run an example of what I ran, which I consider preferred funding, how much we'd really like to put into an index universal life plan, make sure the client's going to get the maximum benefits out of that based on the amount of premiums going in. Then to make it really simple to understand the whole process, I'm going to give you a premium and then distribution summary of all 4 plans. Then I'm going to give you a death benefit summary of all 4 plans. So it should give you a really good view. And this will be in the back office. You'll be able to watch it. You can go over training with your teams. I can even make this PowerPoint available for training, not for consumer use, but for training. So the example we're going to look at will be a male age 52 wanting $1 million of life insurance. And that person typically won't know what in the heck kind of life insurance to buy. Should they buy term? Should they buy return of premium term? Should they buy cash value IUL? And if they do they target fund it? Do they overfund it? They don't know what to do. So we got to make sure we all understand how it potentially could work, and then you'll be able to make better and better recommendations and help someone become a little bit more financially secure simply because of your knowledge. So let's start with term and how that would work. Here's a traditional term plan, and it's going to show year 1 being the first year, age 53, and we're going to look at 20 years worth of coverage going all the way through age 72. And we can get this type of plan. And this is assuming, I believe, a preferred individual, male, and for $1 million for 20 years of coverage, it's $4,642 a year. So about, what's that, $350, $360 a month would give that person $1 million. So that's pretty cheap, because you got to figure a 53-year-old pays $4,600 and they die during the first year. The beneficiaries are going to get $1 million. That's a tremendous use of leverage, tremendous use of their assets to leverage more assets for their legacy. If you look at 10 years down the road, they paid in $46,000, and if they pass away, $1 million is going to be paid to the beneficiaries. If you look at 20 years down the road, they would have paid in about $92,000, and again, if they die when they're 72, 20 years down the road, they paid in $92,000, but the beneficiaries are going to get $1 million. So again, tremendous leverage. It's important to look at with traditional term. We know, because we talk about it over and over and over again, that in the 21st year on, since this was a 20-year term plan, there's no more insurance, no money comes back, there's no premium refund, it means the insurance over. But we had coverage at the cheapest possible price to protect our families during that 20-year time period. And if someone wanted a $500,000 amount of coverage, the premium would probably be half. If someone wanted a $2 million amount of coverage, the premium would be about double. So you can use this as a really good guide on how this would work for someone who's 52, 53 years old, male. So some people say, well, that's great, lowest premium, but I'm not going to get my money back, so I don't like that as well. Is there any way I can get my money back? Because I don't want to plan on dying in 20 years. I'd rather pay a higher premium and get all my premiums back if I don't pass away. So I ran an analysis here. It shows return of premium term, $1 million, and in this case, premium was $12,340 based on this individual's age. So premium went up. But if we pay it in for 12 years, well, let's look at the first year. You pay in $12,340. If that person dies in the first year, the beneficiary gets $1 million. So it really doesn't matter whether someone pays in $12,000 a year or $4,000 a year. $1 million is a huge leverage of that amount of money. If that person pays this amount in for 10 years, they pay in $120,000. If they pass away, the beneficiaries are getting $1 million. If they pay it in for 20 years, the individual is going to be paying in $246,000. If they die in that 20th year, the beneficiary is going to get $1 million. So tremendous leveraging. The benefit with return of premium term, as we've talked about so much, is after 20 years, the term is over, but after the 20th year is done, the insured, the individual is going to receive, as long as they're still living, a check, a lump sum check for $246,800. Every single penny paid in is going to come back. So it's a simple way, it's an easy way to tell people you're going to benefit no matter what. I know you don't want to plan to pass away over the next 20 years, so what if you live and you get all your premiums back? If you die, your beneficiary is going to get back 4 times more money than you're going to get back in the end, so it does provide that adequate coverage, and that's return of premium term. A lot of people love Index Universal Life out there. I know Robert Aguilar loves it. Nancy Versos loves it. Emily Demdemai, a lot of people out there selling it. You know, Betty Pham, when I was up there, she loves it. She just delivered, actually in front of the entire group up there in Seattle, she delivered, I think, 2 policies when I was there to the people, the associates who had internal consumption field training matchup sales. It was awesome. It was Index Universal Life, so it was wonderful to see that. Well, let's look at then target premium. So target premium will typically be the minimum premium someone can pay to get that coverage. It also is going to be the amount of premium you're going to get paid commissions on. So in this case, the death benefit was $1,041,000, and the target premium in this case was $26,400. This person said, I can't afford to put that amount of money away because I want to get a lot more money back for my retirement. So we said, okay, let's do a 15-year plan, because typically if you fund one of these for 15 years or longer, you got a great opportunity to get a lot of money out of it based on the current assumptions. If you fund it for a lot less, it doesn't really allow for a tremendous amount of cash outflow. If you can imagine, this individual puts in $26,400 into the plan, puts it in for 15 years, and then based on current assumptions, current illustration assumptions, which is what the plans have earned for the last 30 years in this case, after putting in for $26,000, having coverage that entire time. So if this individual puts in $26,000 the first year, if he dies, they're going to pay $1,041,000 to the beneficiaries. Tremendous leverage. If he puts in $26,000 a year for 15 years and dies in the 15th year when he's 67, it means he would have put in about $390,000. But he still, if he died, his beneficiaries would get $1,041,000. Again, tremendous leverage. Now the benefit is here if he lives, if he wins. After putting in $26,400, he stops putting money in, and he starts taking out $66,537, and that's going to come out every year. And based on insurance and using code section 7702 of the Internal Revenue Code, if planned properly, they're going to be able to take that out on a tax-advantaged and tax-free basis. And in this example, using target premium, he's going to get $66,000 a year all the way through age 94, way past his life expectancy. So think about it. Puts in $26,000 for 15 years, and is going to take out $66,000 for about 25, 26 years. That's a great deal, just a great deal. If people see this, they'll do this. If you show this kind of illustration, show the illustrations when you run with people, they'll do it because it's a great opportunity for them. They have coverage, and if they don't pass away, they get their money back in the form of income distributions that are going to be tax-free. Now, instead of paying the $26,400, the minimum premium, we talked about this before, I prefer to go with what's called an IUL preferred premium. I just calculated out what I thought would work, and I think instead of the $26,400, let's pay in $2,400 more per year, $200 more per month. By doing that, just by paying $2,400, which for this particular individual paying $26,000 or $28,000 didn't matter. If we do this for 15 years, we now can take out $77,000 a year. So instead of $66,000, we're going to be taking out $77,000 a year, and this would then project out all the way through age 100. So if you can imagine putting in $20,000, almost $29,000 a year for 15 years, so age 67, and then from age 68 to age 100, about 32 years, taking out almost $78,000 a year in plan property on a tax-free basis. Just that little extra $2,400 gives us about $11,000 or $12,000 more income per year, and it lasts about 6 more years. That's why it's important to fund these with what I call the preferred premium, and you might have to do a couple illustrations and have either O or G run it, or you run it yourself and find out where that sweet spot is. What I also like to do then is to look at how we can compare all of these at once. So here's the traditional term in the left column, ROP term, the premium, then the distribution, IUL target, which is premium, distribution, and IUL preferred. So it's nice to see on this one page that for traditional term, we pay in $4,642. In that case, if we die anytime during that 20-year time period, our beneficiaries are going to get $1 million. With ROP term, we're going to pay in $12,340. If we die during that 20-year time period, our beneficiaries are going to get $1 million. If we win and we live, after 20 years, we're going to get a lump sum paid back from the insurance company of $246,800. Think about that. You get almost $250,000 back. You paid it in, you get it back. It's an awesome way then to help supplement retirement dollars. If you look at then the IUL target premiums and then distributions, for the target, it was $26,400. We pay that in for 15 years. Then we are going to look at taking out about $66,537, so age 94. If we go with the preferred premium, which is only $2,400 more per year, we paid in for the same 15 years, but we take out almost $78,000 out per year all the way till age 100. So that's a little different. So the one blue is going to say age 94, the green is going to say age 100. So tremendous difference just to put a teeny bit more money in to really fund that and supercharge it. When you look at the death benefits then, traditional term is going to give us that $1 million for 20 years. ROP is going to give us $1 million for 20 years. In this case with IUL, target, and preferred, we get $1 million all the way through age 67, but then we're going to start taking out tax-free loans from the policy, so that's going to decrease the death benefit. But even at then age 75, we still have $400,000 and $300,000, and I ran it out, and at age 95, we still have $653,000 of death benefit with IUL target death benefit, and we still have $682,000 at age 95 with the preferred, the amount that we're putting with the preferred premium. So it really gets to show us how the different plans work. And on 2 pages, and we'll toggle back to this one, 2 pages, the premium going in, and either the return of premium coming out or the annual income distributions coming out shows how term works versus return of premium term versus IO target and then IO preferred. And then it also shows us, very important, what the death benefit is and how that's going to work. What I'd like to do is bring, I'm not sure if Mike Kenzik got back on. If he came on, I'm going to bring you back on, Mike, and also have Jim Janaki come on and give their views of what we talked about today. Mike, are you on? All right, maybe not. If he comes on, that's fine, Jim. Jim, you available?
Hey, Dan. No, that's great stuff. I mean, it really lays it out simply in regards to the power of what we offer everybody out there. It really is powerful. Each step that you've covered is very, very powerful, and I hope people are taking notes, and I hope people understand it, because, I mean, to be able to explain this and understand this and to be able to watch what you just did in our back office like we do. We record these every time, and then people can watch this many, many times to understand each process of how it works. It's so important to be able to understand what you're involved with, and when you do, and you can break down these little segments that Dan's talking about, it makes all the difference in the world, Dan.
Well, Jim, in this, if you look at then putting in either target premiums to the IUL or preferred premiums to the IUL, whatever we put in for 15 years, can you imagine that it's going to project out that in 6 years on either case, you're going to take out every penny that you paid in the first 6 years of retirement, which means from age 68, 69, 77, so through the age 73, you would have taken every single penny that you put in out. You had insurance coverage during the time period, and after that, it's just gravy. Just gravy.
Yeah, absolutely. Yeah, it's a win-win across the board.
Yep. So nice to see then how you can start looking at how this fits for you as far as an individual that's purchasing these plans, for the internal consumption sales you make, for the field training matchup sales, and that's why we have everything that's necessary for you to succeed right now. We have all the products. We have the explanations of the products, the training, we have the illustrations, all the things that are needed we have right now. Is anyone else live, Jim, on the moderate side that you can bring on?
I'm on here. This is Mike.
Hey, Mike. Hey, Mike. How you doing?
Good. How about you?
Good. Did you get to catch all the training?
I did. It was great. I like the way we can compare the different life insurance that you compared. This is really nice way to lay it out and explain it for people. It shows the value of putting just a little bit more money. As you put a little bit more money in, you get quite a bit more benefit out. And I think that's what's really well illustrated here, and really shows the benefit of life insurance, of being able to use your money to accumulate tax-free and then taking it out tax-free at the end with the IUL product.
No, definitely. Well, and I think it's important to understand that, we have to make these plans fit into people's budgets. And if someone needs $1 million of coverage and they can only spend $50 or $400 a month, we have to sell them traditional term. Because if not, then their family's not covered. If then they say, well, I really could go up to $1,000 a month, I need that $1 million of coverage, then we know we can probably go with ROP term. They're going to get their coverage for 20 years and they're going to get all their money back. If they say, I really need to fix my retirement, I need to restore and recover my retirement, then we can look at, okay, how much can you afford to do? And they say, well, I need $1 million of coverage, and I'd really like to be able to put in somewhere between $25,000 and $30,000 a year to restore my retirement, and I can do that all the way through age 67. Then we can do one of the IUL plans in this example. If someone needed half the amount of coverage, we could cut these numbers in half, and you'd be looking at saving $14,000, $15,000 a year and be able to take out around $38,000, $39,000 every year. And you've seen it happen all the time with illustrations, right, Mike, as far as what people are running right now?
Absolutely. Yeah, I mean, this is really nice to be able to split it out like this, guys. You cut it in half, it's completely scalable.
All right, well, go back to Jim Janaki one more time, and then I'll make a final comment, and we'll be done with a very short but powerful.
Hey, Dan. This is Jim Files. I just want to make I want to make one comment.
Sure.
Hey, there's a lot of people on the call tonight, and some people are apprehensive about getting in front of clients. They've been newly licensed, and they may have only been up with one matchup sale, two matchup sales, but all they have to do, and if you're listening on the phone tonight, all you have to do, this is being recorded, just go to our back office, listen to the way Dan presented this 2 or 3 times. It's color-coded, it's so simple to understand. Anybody that has their license, even if you've never sold before insurance, if you just listen to Dan's presentation tonight, look at the color coding, walk through it yourself at home with your wife, you'll be able to get in front of a client and be super successful, because Dan has done an excellent job of taking something that may seem complicated, but he netted it down to be super, super simple. Back to you, Dan.
No, thank you, Jim. And I think what you said is the key. What our goal is always to bring you tools that are going to make complicated things, meaning anything in finance, simple. And then you have to do the same thing with your team, with your clients, whether it's internal consumption, whether it's field training. You have to be able to explain, and this allows you to explain the concepts very simply on this is how the concept, this is how 4 different types of insurance for plans we would run, even though it's actually traditional ROP and IUL. It's also showing them the difference on IUL and being able to explain to people. It's important to understand. They might already own IUL, but they might not even know that if they funded it, if they would have been recommended to fund it a little bit more, they'd have a lot more money, a lot more security. So good comments, Jim, and the whole goal, of course, is to make this simple. Mr. Janaki, any more comments from you?
No, I tell you, you hit it perfectly, Dan, and the way you break it down with the traditional and the return of premium. I mean, it's very, very powerful, and how this thing works. And I think people should understand easily, based on your presentation, what they need to do in order to take advantage to not only help the clients, but also help everybody on their team, as Jim Files was saying. I mean, make sure that you guys, make sure your team understands this like you understand this, and then you'll have some true replication and duplication that will really have a successful business, Dan.
No, excellent. I think my final point will be what Jim Janaki was just talking, what Jim Files was just talking about is 70% of our sales are going to come from your team. They're going to come from internal consumption sales, and they're going to come from field training matchup sales. So you have to make sure everyone on your team understands this, otherwise those sales will not be made. And that's really the number one reason that we'll use this. It's great to use, be able to talk to consumers and educate everyone so they know how to talk about term, return of premium term, target funding for IUL, and preferred funding for IUL. But most important, you got to make sure your team understands, because if your team understands, they're going to buy internal consumption policies from you. They're going to buy field training policies from you, and you're going to teach them how they can now sell internal consumption sales to their recruits and how they can help their recruits make field training sales. It's that simple. I think this is one of the most powerful things we can do is simplify how insurance products work, and it'll be very, very, very successful if you walk this through with your team do training, grab the PowerPoint from me, get in the back office, just listen to us do this again, and I think you'll be very successful with it. So hopefully you enjoyed this. Hope everyone got a lot of information out of what we're trying to do today. Again, very, very powerful topic, but simple. And again, it's not necessarily easy, but it's simple, and we will help you succeed. Make sure you let us, any of us know if you need some help. Give us a call. We're available, and we look forward to hearing from you tomorrow on Quantum Connection Live, 7:30 a.m. Pacific Time, 10:30 a.m. East Coast Time. Thank you very much for joining us. We hope you enjoyed this call. Have a great day.